Are you live on
Instagram.
Instagram?
Yeah, I just want people to see behind the scenes on our show. They're not going to be able to see any slides. But
I see what you're saying. You're on your phone.
Yeah, it's a little side view. Those of you that are joining us, welcome to our monthly BLT. There it is. Oh,
look at
that. That's a face made for radio right there.
I like it.
Welcome to our monthly BrewRE Sacramento region real estate update. My name is Brandon Leon. I am a realtor with EXP here in the Sacramento area. I am joined by none other than Keith Collins, the mortgage lender. Did you see him with the guns right there? He was like, boom, let me just, I
wasn't doing that. I was just saying hi. I wasn't even flexing.
Keith is the loan expert extraordinaire. So we're going to go through a lot of good stuff today. We're going to talk about the record-breaking year that we had in the real estate market in 2021. Lots of good stats for you. We're gonna have some dad jokes as we always do. We're going to talk about interest rates and how the impact they're going to have this year, and what is Keith's bold prediction. And we also, every single month, as we do this and share these stats, please ask your questions, guys. You're on any of the social media platforms. Ask your questions. We'd love to answer them. If we don't get to them here, we'll get to them, personally or on social media. We'll answer them, or we'll answer them right here on the show. So thank you so much for joining us. We're excited to go through this content. Stick with us. We got lots of good stuff to cover. So without further ado, we call it brew in real estate. I don't drink beer, so whiskey is the choice. Today I am drinking Larceny barrel proof. It is batch A120 here. So this is that
Conor McGregor's? Is that Conor McGregor?
No, it's not. That's sad that you would say that. This Larceny got whiskey of the year a while back.
Larceny
did. Yeah.
That was several years
ago. And Keith, what are you up to?
I'm drinking a little book. Chapter 3.
Chapter 3.
Chapter 3. Very good. Little hot, 122 proof. So it's bold.
That's robust. But guess what? I beat you. Man. This is 123.2 proof. I beat you. Just like I beat you in disc golf.
Always a competition.
Yeah, not a big deal. All right, guys. Let's get started. Lots of good stuff to cover. Before we get started, Keith, let's hear your best dad joke. Ready, go.
All right, you ready for this? A ship carrying red paint has collided with a ship carrying blue paint. Both crews are said to be marooned.
Marooned. All right. Okay. Gets a little smile. And for those of you just joining us, we start off every single time with the dad joke. Every single market update with some dad jokes, just to have some fun. We used to try to make each other laugh, but now we're just having a good time. I think if you laugh.
I just feel like
you've never made me laugh ever in history. You're just not funny that way. But so you might have heard this joke before. What's the difference between Dubai and Abu Dhabi?
I have not heard this one, and I don't know. What is the difference?
Well, the people in Dubai don't like the Flintstones. The people in Abu Dhabi do.
Okay.
Don't giggle. Oh, okay. Derek, we got him.
Oh, that's funny. Abu Dhabi do. I think the best part though is that you on my screen you froze, like completely froze when you just at the point that you delivered the joke. So there's an asterisk. There's an asterisk on that one.
I'll take it. I'll take what
that was good. All right. I like it. Moving on.
We ready to get into?
Let's do it.
Oh, here's my honorable mention though. So poop isn't my favorite thing to talk about, but it's a solid number 2.
You should have led with that. That was hard for me to keep that one in.
Yeah, good one.
All chemists know that alcohol is always the solution.
That's true. I think engineers would laugh at that. But
all right, rock and roll.
Here nor there. Let's talk about some real estate, people.
Yes, sir.
And, again, anybody? Hey, good to see you, Tracy, Julia. Thanks for joining us. Make sure to ask your questions. We're going to get started without further ado. The first thing we're going to talk about today is how many records were broken in 2021 in real estate, and not just really our region, but just in the United States in general. It was crushed. Like every record you could think of pretty much has been broken. Fastest moving market, I would say, ever. So as we go to our first graph, and we're talking about Sacramento real estate market update. So we have lots of good stuff to cover here. My computer just went all funky on me. We have some good stuff to cover here. So as we look at this is Sacramento, Placer, Yolo, and El Dorado counties. The average days on market was 17 days overall. So for the whole region, houses were getting into contract within a couple weeks, right? If you look at the median, it's 7 days. So the median is, I mean, a week or less, right? And just for fun, if we go back to we look at 2007, it was 101 days or 71 days, you know? And that was what we considered a normal market at the time. And that's what blows my mind is we're so used to these crazy numbers that I remember having a conversation with somebody the other day and they're like, this house has been on the market 18 days. What's wrong with it? Like we're now having that conversation where that was completely normal, you know, for years and years and years. So just knowing that the average days on market is because we have such limited inventory, just knowing that it's gone down and down and down. I'm just curious to see how that plays out this year. Keith, you have anything to add about that?
No, I think it's just, I think that it's just from an expectation setting standpoint, you know, that's the median. That's not all homes, right? You know, if you got a home, you got a home. I've heard stories before, you know, agents say the median 7 days and you're setting next the expectation of the client, and then their home's on the market for 2 weeks and they're like, what'd you do wrong? And so, you know, that's a median, but that's just crazy that it's 7 days. I mean, it's an extreme lack of inventory. And when I see stats like this, you know, it's always, I don't know. It's hard when you see stats like this and you're having conversations at times with clients where they say they're just going to wait for the market to correct in the next year or two. And it's like, it's so far the other direction right now.
Yeah. Yeah, no, it's true. And, you know, when you look at these extreme sellers markets that we're in, regardless of what the interest rates are doing, we're still at such a shortage, you know, of homes that it's not really going to make a difference. They're still going to move quickly. And people are moving out of the area and people are moving into the area, of course. But either way, that's a crazy stat. Let's move on to the next one. On our next graph, check this out. Highest dollar growth ever. So if you look at the far right of the graph, the average sales price has gone up $99,000 as a region. The last time it's been negative was 2011, where it was down 19,000. Look at last year, guys. Last year, 2020. So technically 2 years if we're in 2022 now. But, you know, this is a real estate market update for January, right, of 2022. But we're looking at the full last year of 2021. If you look at 2020, it was 46,000. So it's more than doubled, right? In the average price dollar change. It blows my mind. And I know I've done videos. I do market updates every single month, and some areas have gone up, you know, over $150,000 in 1 year. But when you look at this place regionally, I mean, you're talking about 4 counties, 99.
Yeah, that's a big number. And I think what that makes me think about too is there's a lot of clients, you know, we're going to talk about this a little bit with interest rates moving up, and there may not be the opportunity to refinance, but I think there's an opportunity for a lot of clients. I actually had one, they've been in their home for less than a year. They put 5% down. They're now at that 20% mark, and they just applied to have their mortgage insurance dropped. And so they're not able to refinance and save money to get a lower interest rate. But because home prices have gone up so much, you can get rid of that mortgage insurance in some cases because you're seeing $100,000 increase in median value, which is crazy.
Well, I mean, you're seeing that, and you're seeing that value increase. So yeah, the mortgage insurance is one way, but you can also maybe have an opportunity to buy in a different market that may not be affected as much as ours. So there's also moving out of the area, or moving to buy a house with acreage, or a move up buyer or something where you may be able to sell in a market that's not affected as much as the other one, if that makes sense. You know, there's opportunities are endless because people are now having more equity in their houses than they have before. So you now have more money to pull from and more of a down payment to buy another house. potentially. So
you know what
I think
also is kind of crazy with that, Brandon? And I'm sorry, you know what's crazy with that too is with a $98,000 increase. If you took somebody and they put 5% down on the median purchase, and that thing went up $98,000, that's a plus 400% return on your money in a year.
Where can you get that in the bank?
That's wild. That's yeah. All right. That's
why. All right. It's fun. It's fun. All right. So we're going to go to the next slide here. This one is also, they're all pretty amazing. These are fun. But so in the last 18 months, this is what this says. In the last 18 months, we've had less than 1 month of supply. So we've had less than 1 month in 18 months straight. So what that means is if we didn't list any more houses, right, we would run out of houses in a month. That's how much inventory we have. That's what that means.
Based on current sales pace, right? All homes are available based on current sales pace. We're out of homes in 2 weeks. Yep.
And so for the past 18 months, we've been under 1 month, and that's in all 4 of these counties, right? So that just goes to show. And as you can see, you know, you go back to a time where it was over 2, and that was in 2020, April 2020.
That's April 2020. That was COVID. Like it's still COVID, but that was like the shutdown.
That was when it completely shut down, right?
Correct.
And then you can see it just goes down, down, down because people are like, I need to move. You know
what's really interesting on that too, Brandon, is so I'm sorry. It's so that like, you know, kind of traditionally you would say anything less than a 3-month supply is a seller's market. And we had an event in April and May of 2020. And that was a shutdown, right? Like you couldn't leave your house. You couldn't sell real estate. There were times, Brandon, where you guys like couldn't show homes, right? Like you couldn't, you can't, right? I mean, it's an absolute shutdown. And in that time, it still didn't go over a 2-month supply.
Right. That's a problem.
Yes, we need houses. It's an inventory issue.
We need houses. Yeah, we are still in a 1,500 house per year deficit in this area for new households formed. It's just incredible.
What you mean by that is based on current building. So when sometimes I think we look around the local area and we're like, dude, they're building houses everywhere.
Right.
You know, how is there a supply issue? But based on current home starts and demand, we're still short. So not only are they're catching up to demand, they're still going backwards every single year in demand because they can't keep up with pace.
I know.
The builders. You know, I've had that conversation in bars before. They're like, what are you talking about? There's a supply issue. They're building literally everywhere. And I'm like, yeah, I know. It's still not enough.
Not enough. So true. Good stuff. All right, let's move on to the next. Here's a fun one. So highest percentage of multiple offers possibly ever in history. We only have this graph for 5 years or so, but I'd be safe to say that we have had multiple offers like we've never had before. So what that means is a house goes on the market, multiple buyers want to buy it, they submit offers, you're in a multiple offer situation. So check this out. So in April, we had the highest percentage of multiple offers ever at 76%. 76% of houses in the Sacramento region had multiple offers in April.
More than one offer on it.
More than one offer.
Wow.
And that alone shows you how competitive this market is. And it's not a deterrent from buying a home. Like if you're watching this right now and you're thinking about buying a house, it's not a deterrent from buying a home. You just have to have the right team. You have to have the right plan. You have to understand the old way that real estate used to be done and the new rules, what the new rules are and how to win and compete at a new game. It's just a new game that you're playing. It's not like it was before. So, Keith and I have never got someone pre-qualified for a loan and been really committed to, finding a house. We've never had someone not get a house and not find a house that they absolutely love. It just takes a different level of commitment. So I thought that was pretty cool.
That's awesome. Yeah, sales of multiple offers. It'd be interesting next month when we do this, if you broke sales by multiple offers by like price range. I'd be curious to see like what price ranges are like, oh wow, that's the zone that you're super competitive.
Yeah. Sure. That'd be a good one. Love it. So let's go to the next one, Derek. So this one's cool, and we're gonna we got one more stat, but we're mostly going to end this from a graph standpoint. So this is sales price to original list price in the Sacramento region. So as we look at that, buyers have paid over the list price for 1 year straight. So for a whole year, they have paid over the list price. So over 100%. So if a house is for $500,000, they paid more than that. So coupled with our last stat of seeing how many multiple offers we have, that would be indicative for us to understand why we are actually having 100 as high as 104% in some areas. And of course, it's cyclical like everything else. But what's great about this graph is it shows the difference of this year versus 2018, 19, 20, 21. So it shows all these 4 past years in these graphs on how it got even close to 100. I mean, the only year it got over 100 was in 2020, barely. But all the other years are well under 100%. So when I talk about the old market and the new market, it's like the old way was like someone lists the house on a higher end and then a buyer comes in and low balls and then they negotiate in the middle. Like the real estate market is no longer that way. Now price is non-negotiable, and now we're trying to focus on terms and figuring out how to offer the best price, but how to also protect the buyers as well, against paying so much money over that price. But when you're having stats that we're showing you, like house prices going up $100,000 in 1 year, like to pay an extra $5,000, $10,000, $15,000 on your house, like it's not that big of a deal compared to what we're seeing, how much appreciation is happening in these houses.
That's a fair thing. Going back to your original slide to say that the median area went up like $98,000, and you're taking somebody that bought the home and they went $20,000 over list, and they're thinking, "Hey, I'm not getting a great deal." You know what I mean? I mean that they made a lot of money even though they went over list.
Right.
Yep.
Yeah. So just something to consider. These are all stats. I mean, obviously, if you guys have specific situations or questions, we'd love to answer them. We're here to help, but we're just showing you what the market's done. And now we're, in a minute, we're going to talk with Keith about interest rates and where they're headed and what we see happening in this market, and what our predictions are for the year. But before we go into that, kind of my last little stat here is, so we actually had more $1 million plus sales than ever. So that's kind of fun. So what I mean is 7% of all sales in these 4 areas of Sacramento County, Placer County, Yolo, El Dorado, 7% were over $1 million. 7 out of 100 homes were over $1 million sales. We've never had anywhere close to that. Right. So that shows the appreciation, and that shows that a lot of people are moving in the higher priced areas, and due to appreciation and higher priced movers. It's like, man, there's opportunity everywhere. So whether you're entry level buyer or somebody that is looking on buying in a in a Granite Bay, in a Loomis, in a nice area of Rockland, and in a nice area in Sacramento, whatever it is, there are lots more sales in those higher ranges. So there's opportunities on both sides.
Love it.
And that is our 2021
market update
recap, Sacramento market update. And now Keith's going to talk a little bit about interest rates and what we have on the docket as far as, or the forecast of and prediction of what he thinks is going to happen in the market for the rest of the year.
Yeah, I mean, and inflation. Let's just jump into it. I mean, inflation is. We were all hearing about it. Inflation is, plus 6% year over year, and still increasing. And I think that's kind of the big common theme related to interest rates. Inflation is the arch enemy of a 30-year fixed loan. When we see inflation creeping into the market, at some point in time, interest rates are going to go up in the future. Mm-hmm. And the reason they haven't gone up as fast is because the federal government has been purchasing mortgages at a large number to kind of keep those interest rates down. And 2 things have recently happened. One, the Federal Reserve has indicated they're concerned about inflation. Who knew? And they've also indicated that they're going to slow the purchases of mortgages, meaning They're not going to be the entity that's trying to force 30-year fixed interest rates down. They're going to allow them to go up a little bit. And both of those mechanisms, raising the federal funds interest rate because they're worried about inflation, and allowing interest rates to move up a little bit, is a mechanism to try to slow the economy down. So I think that throughout this year, we're going to see interest rates move up. And if you put that slide together up there, Derek, just on the interest rates that I sent you, just trying to show kind of like how quickly interest rates have moved. This is basically a look back since August. But if you kind of see this, the big slide that we've seen, red is bad, green is good, right? So as we see a lot of red there, interest rates are getting worse. And it's almost just kind of an inverse. Like if you were to flip this upside down, that's what interest rates have done, right? So as if you flip it upside down, interest rates are moving up. I guess the other way. Wow, that was well done.
Yeah, so, man. Now you go right to left.
I love it. So if we look at this in November, you may recall that's really when the Federal Reserve started talking about the concern over inflation. And as soon as they started to do that, we just saw interest rates move up. And I've been doing this for 18 years. This is probably one of the top 3 times that I've seen in terms of interest rates moving up in such a short window. We've probably seen interest rates move up 0.5% really since November. So now, the interesting thing is, I was learning this. I'm like, what does that really mean? So interest rates have moved up 0.5%. If we were to take a $500,000 loan, and really the difference in payment on a $500,000 loan with 0.5% is $140 a month. So it's absolutely a number, but I don't know if that's necessarily a number that's going to change somebody's decision on buying a home or not in that price range. So there are ways that we can look at trying to get lower interest rates for individuals based on their time horizon, paying points, and buy the rates down or not. But I think that we're in a market where we're seeing increasing interest rates. And I think that we have an opportunity to maybe see those rates move up another 1/4 to 0.5% throughout this year, with the Federal Reserve increasing the federal funds rate and with us seeing inflation. I think the big thing here is you're going to hear on the news, anytime the Federal Reserve raises interest rates, that does not mean a 30-year fixed rate changed immediately. Does that make sense? I get that a lot. The news is heavy in anything related to real estate, right? And so whenever we hear the Federal Reserve changing interest rates, I always get numerous phone calls from customers saying, well, did rates go down the 1/4% or rates go up 1/4%? When the Federal Reserve is doing this, bond traders, stock traders, Wall Street kind of already knows what the Federal Reserve is going to do. And so it's already baked in. So when they make that announcement, we don't see an immediate rate increase or rate decrease. But all that to say, I think that we're going to see some higher interest rates throughout this year. I don't think interest rates are going to get into the 5s, but I think they could get into the low 4s. That's a reality. Also, the Fannie Mae and Freddie Mac basically just came out and they said that they're going to be increasing interest rates on second homes. So most lenders will have that take into effect at the end of this month or starting in February. But we're going to see interest rates move up about 0.5% at minimum, just with this lever change on second home interest rates. So I think that they're doing that. Yeah, go.
At the time of this recording, right, what are interest rates currently today as of January 11th?
They're like in the mid 3s. They're in the mid 3s, 3.5, 3.625 on a 30-year fixed loan without any points or fees, depending on credit score and down payment. Right, there's some stipulations that people have to qualify
for.
So
we're not even a month in, of course, but so we're saying that within the year they will most likely be up in the low 4s.
I think that we could potentially see interest rates another 0.5% higher by the end of the year. This change just on second homes and high balance loans, this change. So there's a market change, right? What's happened in the market to increase interest rates, but then also Fannie Mae and Freddie Mac are just changing the lever overnight. They're basically saying we're just overnight going to raise interest rates on high balance loans, so higher loan amounts, and on second homes. And that at minimum is going to be 1/4 to 0.5% in rate.
Yeah.
I think that they're doing that on second homes just because we're seeing a lot of people, because on a second home, so second home meaning it's not your primary residence, it's not an investment property, typically some sort of a vacation property, one that you go to, but one that you can also rent short term. With the rise of Airbnb and VBRO, we're seeing a lot of people purchase second homes and Airbnb them. and really making them an institutional investment, but kind of calling it a second home. And so I think that Fannie Mae and Freddie Mac are seeing that, and that's why they're raising interest rates on those products.
Oh, that makes sense. That makes sense. And so as you guys are watching this, as we recap, we just talked about the craziest real estate year we've ever had in the region, records everywhere, but we're also seeing interest rates rising, and they could be in the low fours here, coming the rest of the year. And again, we can't predict the future, but it's safe to say there are going to be interest rates are going to rise. And so how does that affect you in your current situation? And maybe you're somebody that's like, hey, I now have equity in my house and I want to potentially sell my home and buy a home. And that's great. But it's like, okay, well, maybe the market's going to adjust and I'll just wait later on in the year. Well, you're losing buying power, as you wait through the year, as interest rates go up, and anybody looking to refinance, like you're in a tough situation as well, as interest rates go up. So, if you've been on the fence and you're thinking about waiting, regardless of if we're the team to help you or not, making a move sooner rather than later, statistically, I think we look at graphs all day, all the time, like it's part of what we do. So we need to know the cycles of real estate. We need to know what's going on, and we're experts in this area. But that being said, I mean, the market really starts to shift. Everyone thinks it's the summertime, but the market really starts to shift in February, in early spring. That's when we start to see the market shift and more sales happen, and it, it tends to get busier around that time. And so, if you're thinking on making a move, or you have questions about, the right decision to make for you in your scenario, you can reach out to Keith or I, and we love to help and answer questions for you.
Absolutely. And I think, you hit on something real quick, and I'll wrap it up, is, we were in a historically low interest rate environment for a year and a half period of time. I think the majority of people that couldn't refinance hopefully did refinance during that period of time, and we're going to see people with really low interest rates. There was a period of time in late 2020, early 2021, where lenders literally couldn't keep up with the business that was coming in the doors. We hired like the Yankees to try to bring on staff, and still was not enough. We could not keep up. And now we're in a place where we're seeing interest rates rising, and everybody has lower interest rates, and refinances are falling off a cliff in terms of the amount of volume that we're doing in the industry. And we're starting to see, unfortunately, some mortgage companies laying people off. I think what we're going to start to see, and this is just more of a public service announcement, right? I think we're going to start to see, as we see these layoffs, we're going to start to see some desperation in some of these big box lenders and some of these call centers. And we're going to start seeing really high pressure sales. And if you're sitting in and I've had a couple clients come across my desk that are previous customers saying, hey, I've got this guy, he's trying to sell me on this. What do you think? And I'm like, if you're going to sell the home in the next 2 to 5 years, this absolutely does not make sense. You're going to lose money on this transaction. You're sucking up your equity with all these refinance costs. And so I would just say, take your time. Don't rush into a decision on a refinance. Make sure you're looking at the total cost analysis as far as what is the savings over time. And I think it's going to be, if you're in a low rate right now, it's going to be hard pressed to do a refinance and have it make sense if you think you're going to sell in the next 2 to 5 years based on current rates. But take the time. Don't get pressured into a refinance because you think rates are going up. And we're starting to see that high pressure sales, unfortunately, out of some of the big call centers. Yeah.
No, that's good. That's good info. So Keith, you have any last minute things to say here before we wrap up?
No, man, I think the big message here is with values going up so much, so rapidly, I think there's a lot of people that are in a situation where they have mortgage insurance and conventional home loan, and they may be able to just drop it. And at times that mortgage insurance is $200-$300 a month. So even though interest rates have increased, you don't need a refinance to get rid of the mortgage insurance. And with values increasing, call your servicer, call the 1-800 number on your mortgage statement. And if your values increased significantly in the last year, ask them if they have any policies in place to remove the mortgage insurance without a refinance. It could save you a lot of money and maybe only cost you a couple $100. I think it's worth it. It's worth the call.
Guys, call your servicer, call the person that has your loan. When you get your monthly, balance or statement, you call them exactly like you said. You ask them if they have any policies or anything in place to see if you can drop your mortgage insurance. And I don't know about you, but saving an extra $200 or $300 a month is a win in my book. 100%. So take his advice on that. Lastly, before we close, our listing of the week. We have a listing that just hit the market just a few days ago. This is 638 Commons Drive in Sacramento. This is actually in Campus Commons, which is right down the street from Sac State, really close to Sac State. Rarely do these ones that over 2,000 square feet, rarely do these come up. So this is a larger one, 4-bedroom, 3 full bath, great property here. We have it listed at $599,900. You know somebody that's interested in that, feel free to reach out to us or tag us in this. We love to hear from you guys. If you have any questions, let us know. But we appreciate you guys checking in and going through all the stats with us. And we hope to see you next month in February. Have an amazing one, guys. Cheers.
Stay classy.